Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone and welcome to the Smart Property Investment Show. I'm Phil Tarrant. I'm the editor of Smart Property Investment and I'm also a passionate property investor. And we've got Jeremy Yarnazelli in here for the Smart Property Investment Show podcast. So say hello to everyone, Jeremy.
Hello guys, how you going?
Jeremy, he's one of the sort of most driven young investors I think I have seen. He's only 26 years old. And this guy has already got 9 properties under his belt, and that's totally blown me away. I've known Jeremy for a while, a couple of years now, but I didn't realise he was that far progressed in his property buying. And I'm pretty impressed. And I doubt there's many blokes at your age, Jeremy, who are sort of sitting there with 9 properties under their belt. Talk me through the choice of accountancy as a career. Now, your old man. He's an accountant, as you mentioned. He works at a big firm, is that right?
Works at a big firm, yes. He works at PricewaterhouseCoopers, which is, I think, Australia's largest, if not the world's largest accounting firm. So lucky enough to see what he done on a daily basis and the choices he made. So it was quite a simple transition that, when you grow up, you like to follow in your idol's footsteps, which at that stage was my dad and still is. And it was fortunate enough to work with another fantastic gentleman, Manzurul, as everyone knows, most probably. And again, another successful property investor. So my influences around me really pushed me in that right position or that right direction to get into property investing and to make a good go of it.
In a lot of families, whether it's a family with children or whether it's a relationship, so a boyfriend and girlfriend or husband and wife or whatever, sometimes finance is a taboo topic, something that isn't spoken about. And when you look at where a lot of problems happen within relationships, a lot of it comes down to financial situations. And the issue is that people don't openly talk about financial issues because there's a stigma associated with people don't want to talk about money. That wasn't the case in your household.
No.
Talking money was good, right?
No, talking money was a daily activity. It was, the grandparents, the aunties, the uncles, his family, his brother was an accountant, my cousin's accountant, my sister's an accountant, his other brother's a lawyer. So it was always a round table discussion, finance, what's everyone doing. I suppose that's a bit of the Italian heritage as well. We like to have everyone's hands in everyone's pockets, understanding what people are doing. But very common discussion around the table. It's not the be-all and end-all in our conversations that we had, but it was a very strong topic, and I'm happy. I'm happy looking back today, all the time that we did spend doing that. It was fantastic.
So you've got a considerable advantage on top of other investors at your age in that, number one, you understand money from a young age. You understand the benefits of having money. You probably understand the benefits of cash flow, and that's what property investment's all about as well. But becoming an accountant, do you think that the fact that you've understood or now you understand money more effectively from an academic perspective, or is it more so of the fact that you've surrounded yourself also with people who, and you said it, successful property investors yourself, that's really given you a kickstart, real head start, hasn't it?
Yeah, it's been a huge advantage, there's no doubt about it. Having an accounting background has allowed me to build the right structure, understand cash flow and the impacts of it from a tax implication point of view. So that has helped significantly. But I'd much probably rather say that having the influences around you, surrounding yourself with like-minded people, surrounding yourself with successful investors, people who have been there and done that, not so much the people who are talking about it and haven't done it, but the people who are in it, they're the people you really want to surround yourself with. I look back and I say, yes, accounting's helped, the knowledge, the experience and having all the advice around it's helped, but I suppose the cherry on the cake, the sweetener on the cake is, surround yourself by like-minded people, successful and experienced people as well. That's without a doubt real life experience, above all, is the key to success.
And this is one of the reasons why we created Smart Property Investment, in that you're very fortunate that you've got that network, family, but also professionally now, where you are around people and you talk about money every day and you understand what people are up to and you can glean a little bit of information. But for us with Smart Property Investment, we wanted to create that product so that people that might not be that fortunate and have that same access to networks can learn from other people.
Yeah, well, as a long-time reader of Smart Property Investment as well, I've been able to see a lot of things that you guys have done. This is going back 2011, 12, 13, those years, seeing all the articles about, the southwestern suburbs and people successfully investing in southwestern suburbs. I think that helped quite a bit as well, successful people and the right knowledge, the right research and the right resources behind you.
Obviously, as an asset class, property really appeals to you for a whole bunch of different reasons. As an accountant, you understand you're not a financial advisor, but as an accountant, you understand the benefits of diversification of asset classes for people who are looking to create wealth. Do you invest elsewhere? I imagine you got your superannuation, that's just mandatory. Do you have an SMSF?
I'm in the process of actually finalising the self-managed super fund for myself now. So I needed to get myself to a reasonable buffer, obviously to invest in a self-managed super fund. Obviously, being at the younger age that I was, it was too early. It didn't make sense. The cost definitely outweighed the benefits. But now as the super fund started to grow in the background, as well as self-contribution, it's got to a reasonable level where I can look at really starting to make the next form of investment, which is self-managed super fund. As far as other investments go, look, I dabble around a bit of shares. I find that, it's good, it's exciting, but at the same time, it's very risky because, unfortunately, you're not in control. You're at the influences of other markets and you're at the influence of directors, and they can go. And we've seen what's recently happened with Dick Smith and a lot of the mining companies. Who would have thought BHP would be where it is at $14, $15. So I tend to look at things that I control, and I suppose that's part and parcel of being an accountant. We like to control what we do. And take calculated risks, and I believe that property is the best way to do it. It's your own research. You do manage the property through the property manager yourself, and really there's no outside influences like other directors making decisions on behalf of your asset. You live and die by the sword, I suppose. So you chose to invest in that area. No one put you there. So you really take your own research into account, and it's a bit of responsibility on yourself to make the right decision. And from that, all the benefits can come through.
So you mentioned that you've been putting contributions over and above in your own super fund.
Yep.
Have we ever torn between, that's cash I could use for a deposit straight away today? Obviously, the tax benefits of doing that was probably something that appealed to you, and you can maximise additional dollars as a result of it. But did you ever get stuck going, I don't want to do these sort of self-contributions into my super fund, chuck it in property instead?
It was criticised quite heavily, actually. Criticised by many professionals that I spoke about it with, and it was something that you're too young. Super's not something you get to retire, and I knew I had that goal that I did want to invest in a self-managed super fund. I establish them for a living, and I see people and I do their accounts and returns for their self-managed super funds. So I saw the benefits. I also saw what a GFC done to super, and to a lot of people's super. So I knew straight away that, again, I wanted to have as much control of my own retirement as much as I possibly could. So, it's a tough one in that essence, but yes, a little bit of tax benefit, but mainly it was more to do with, that was the goal, self-managed super fund. So I did everything I could to get there. And, in the next couple of months, it will eventuate.
So it sounds like with your goal setting, it's evolving over time. So you got your immediate goal, 10 properties, and then you'll reassess, reevaluate, work out where you're going to go next, and move forward on that basis. In terms of the strategy that you've used to secure 9 properties, can you tell me a little bit about how you've done that?
It started off as the foundation property had to be the perfect property. And I tell people that all the time. The first one needs to be the golden egg. Because without that solid foundation, without that good growth at the start, without that good feeling you get of buying the right asset, it really determines and sets up what's going to happen in the future. So I did research, and I knew Campbelltown. I lived in the southwestern suburbs my whole life, in a little area of Casula, and I knew Campbelltown.
Casula, yeah.
Yeah, Casula, mate.
Our family lives out there. I like Casula.
Lived there the whole life, and grew up there. And look, Campbelltown was something I always knew. And it was something that I was influenced. My father and a gentleman I was working with and still am working with, invested a lot in Campbelltown as well. So I saw what the yields were doing. I saw the growth, and I saw the future aspects of the area as well. It is changing demographically, and it was just a no-brainer for me. So I knew I had to invest my time into the Campbelltown region to start off with. So that was a strategy. Buy that solid foundation property, one which was land as well, a land component, to give me that real kick in life. So the strategy started off with the solid foundation, and then it moved on to, cash flow. It moved on to cash flow. I didn't, and again, that old accounting, I didn't want to lose money. I'd rather earn $1 in my back pocket and give 30 cents away to the government than spend $1 and only get back 30 cents in return. So I focused cash flow areas, and I found that it was starting to get a bit tight in the southwestern suburbs. The yields weren't fantastic and purchase prices were increasing and serviceability wasn't that fantastic. So I looked at other areas, and Queensland is something I always knew about. I knew that it suffered quite heavily after a GFC and a couple of floods. So it was, I felt, a very undervalued area. And, with the prices coming down, the yields didn't. The yields, in fact, got stronger as the prices came down. So it was a no-brainer to start looking in the Queensland region, especially the southeast region. And I continued to invest there for a number of years.
I've got a bit of a list here of some of the properties that you've got, and you've got a couple in Woodridge.
Yep.
Which in Logan.
A couple in the Logan
area. I've got
area.
one up there as well, which
Yep.
is good. Bought a townhouse up there for $145,000. I think about the same time you bought. You were
Yep.
in 2013 or so.
Yep, about the same time. About
Yeah,
the
you
same
got
price.
160. There
Yep.
you go. 2-bedroom, 1-bathroom townhouse. How are they performing?
Look, they've done well. Obviously from the time we both purchased them at the same time, the values have gone up to, upwards close to that $200,000 mark, which is good. I was able to pick up a 4-bedroom house there as well for about $216 at the same time. And that's, worth close to about $320, if not a bit more. And the rent is fantastic at $350 a week. A couple of issues on that, but I'm sure we'll touch base on that later.
Yeah.
But, then I was able to buy a couple more in areas of Binley, one more in Redbank, another one closer to the Brisbane CBD, which was a Jaffa. I call it the Jaffa. It's a duplex, both sides, in an area in Maruka, which is about 10 minutes, probably 10 minutes south of Brisbane. A deceased estate. I made really good connections with a real estate agent up there, and she was able to offload the property quite quickly at, I felt, a very undervalued price at $540 for both sides, and it was renting for closer to $700 a week. So good yield, location-wise fantastic. It's not the best looking property, but nevertheless it is both sides of a duplex on a block of land, and it's not Torrance titled, so it's even better.
So staying on your strategy, it sounds like to I guess summarise the quick chat we've had about it is you try and identify under market value assets.
Of course, yeah.
And so that's fundamental to everything that you do. So you want to buy the property cheap, and that's how you make money essentially if you get the property cheap.
Correct. And probably a little bit more the identifier of what an undervalued asset is, and it's not the same answer for every single property, but I try to look where the yield is. And as an investor, the first thing that we're attracted to is it going to cost us a lot of money? What's the yield? The first thing I get asked as an accountant is it going to put money in my back pocket? So I do like to look at yield first, especially. It's got to fit my criteria, close to amenities, transport and CBDs. But I tend to say and tend to see that the value follows the yield. And when we were buying there, yields were 8%, 9%. And it was only a matter of time until the yields came down, not through a reduction of the rent, but an increase of the price. So I tend to say that's my strategy, first and foremost, is yield in conjunction with my criteria. And then it's only a matter of time until obviously the purchase price will follow.
And do you think your strategy will change over time, or do you think that's a proven formula that you're not going to try and tweak it too much?
Yeah,
it's quite simple as well.
Yeah, it's a simple strategy. The answer is, will it change over time? Most definitely. I am starting to look at a little bit more broader strategies. 10 was my goal, and I will get to that 10 mark. But after that 10 mark, I've said to myself that I want to try and change from being just a buy and hold a property into more a buy and create. So I am looking at a bit more, I suppose, riskier things in the sense of development and subdivision. So I want a property with a twist. I really want to, stretch myself a little bit further now to that next level and find properties where I can add value.
So you got an appetite for that? So cosmetic renovations, structural renovations, or granny flat, or knockdown rebuilds, and development. So you'd be happy to look at sort of 2, 3, 4 townhouses on the block?
Correct. That's right. That's where I'm looking, and I think there's a lot of areas which there's plenty of opportunity there for people to do that. So that's probably my next step is to transform the buy and hold into more buy and create.
So it's a lot more sophisticated in that you have to have some experience under your belt to understand the basic principles of property investing, and now you're at that point when, by evolving your strategy to buy and create, do you think that you've got enough time to invest in making that happen, or how do you think you'll manage those type of things?
Yeah, it's a great question. Time is probably against me at the moment, in the sense that I do work and I enjoy working and helping people. So time is probably my only limitation. But in essence, if you want something, you'll find the time. So I will and have designated a bit of time towards that. I try to do at least 5 to 10 hours a week of research for this next step.
When do you do that?
Mate, late at nights.
You're sitting there before you go to bed and just flick through stuff.
Mate, the computer follows me everywhere I go, whether it's a friend's
Sounds
house
familiar.
or the parent's house. I'm sure you're the same.
Yeah.
We've got laptops now, and that's the benefit, that it's portable. So Mate, it's often I'll get home at 7:30. Cook the dinner, wash the clothes, and then it's straight onto the laptop with the telly on, and just look, research, and keep going. Because we've got to find time for these things. You want it to happen. You want to be successful. You've got to put in the hard yards to do it.
A common theme of this chat today, mate, has been around cash flow. So yield, cash flow, and how that's principal to everything that you do. For our listeners who aren't that familiar with the term of cash flow, now to you it's just like a bricklayer lays of bricks. You deal with it every single day, and you don't even think about it because it's such an innate thing for you as part of being an accountant, but also as a property investor. Can you sort of explain to our listeners who might not be that well versed in what cash flow is and how it influences property investment?
Cash flow is more so to do with obviously the rent, less all the deductions, which is your council rates, water rates, your interest, which is obviously the major component, as well as repairs and maintenance and property management fees. And what you're left with at the end of the day, after the rent and expenses have been taken into account, is essentially your positive or negative cash flow. If it's positive cash flow, not necessarily a bad thing. It's putting money into your back pocket, helping to influence the income. Yes, you do pay a little bit of tax on that passive income. And if it's negative cash flow, we do get a bit of a tax benefit arising as a tax deduction, and there is a bit of benefit the ATO does provide us back as in the form of a refund. So for me, cash flow is essential. I like positive income. I like positive cash flow because for me, as I said, I'd rather put $1 in my back pocket and give 30 cents away to the government or 40 cents away to the government than lose $1 out of my back pocket and only get back 30 or 40 cents in return. So it's a bit of a difference. Not everyone has the same, I suppose, scope or strategy. Higher income earners can potentially afford to spend a lot more. But while my income is not exponential, I need to really make sure that, there's money at the end of the week to pay the bills, and it gives me that sense of security.
Thanks for coming in.
I appreciate
That's
it.
good. Make sure you stay in touch. For all of our listeners, we're going to have some more information on smartpropertyinvestment.com.au, so make sure you go check it out. Jeremy will be giving some of his more tips and tactics for how he's been able to build his property portfolio so quickly. Remember also you can follow us on Facebook and Twitter if you want to keep up to date with what we're up to and what we're doing. Jeremy, say goodbye to everyone.
Mate, thank you very much.
Thank you, everyone. See you later.